The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, welcome to our webinar today. The topic of this webinar is designing publicly supported solar loan programs. This webinar is a presentation of the Sustainable Solar Education Project, which is managed by the Clean Energy States Alliance, also known as CESA, and supported by the U.S. Department of Energy's Sunshot Initiative. We have two excellent guest speakers with us today from the Connecticut Green Bank and the National Renewable Energy Laboratory. And our host for this webinar is Nate Hausman. He's a project director at CESA. Before I pass this over to those folks, I'd like to go over a few quick housekeeping notes. All of our participants for this webinar are in listen-only mode. You have a couple of options to join the audio portion of this webinar. You can call in using a telephone, or you can connect using a computer mic and speakers. There are some instructions on your screen for how to connect. A very important note, we ask that you please submit your questions as you think of them throughout the webinar by typing them into the question box on your webinar console and hitting send. We will read through your questions as they come in throughout the webinar, and we will save about 15 minutes or so at the end of the webinar to address your questions. So please make sure you type those in as soon as you think of them. Don't wait until the end to send in your questions. It just means that you have a better chance of us actually answering them. A final note, this webinar is being recorded. You will find a recording of this webinar as well as all of our previous webinars on our website at cesa.org/webinars. And with that, I will pass it over to our host for this webinar, Nate Hausman. Nate is a project director here at the Clean Energy States Alliance.
Thank you, Samantha, and welcome everyone. Before I turn the presentation over to Travis and Ben, I just briefly want to tell you who the Clean Energy States Alliance is and what our Sustainable Solar Education Project is all about. So in case you're not familiar with us, the Clean Energy States Alliance, or CESA, is a national nonprofit network of public agencies and organizations working together to advance clean energy. CESA is made up of mostly state agencies. You can see many of our members on this slide, innovative public funders of clean energy initiatives from across the country. Next. This webinar on solar loan program design is being conducted as part of our Sustainable Solar Education Project. That's a CESA-run project to help state and municipal officials ensure that distributed solar remains consumer-friendly and benefits low and moderate income households. Through the Sustainable Solar Education Project, we're developing a variety of resources for state and municipal officials on topics related to consumer protection and solar equitability. The project is funded through the U.S. Department of Energy Sunshot Initiative. That's their Solar Training and Education for Professionals program. In addition to the guides and the webinars we're producing under the project, we also release a free monthly e-newsletter which contains resources and activities and webinar notices related to solar equitability and consumer protection from around the country. So you can sign up for that newsletter through the link listed on this page. That's the Sustainable Solar Education Project webpage, www.cesa.org/projects/sustainable-solar. And I should too just mention that our January edition of the e-newsletter came out just this week. So you should check that out if you haven't already. Well, with those preliminaries out of the way, let's get to the main event. I want to introduce you to Travis Lowder and Ben Heeley. I'll briefly introduce both of them and then turn it over to them. We'll take questions for either or both of them at the end of the webinar. So as Sam said, and I'll just reiterate, type your questions in as we go, and we'll get to those. And Travis will go first and then turn it over to Ben, but again, I'll introduce both of them. So Travis Lowder is a renewable energy analyst at the National Renewable Energy Laboratory in Golden, Colorado. His research centers on solar PV finance and financial innovations, market analysis, and renewable energy policy. Travis also works directly with municipal governments, universities, tribal nations, and other public and private institutions on technical assistance matters related to PV economics, tax implications, capacity building, and training. Travis holds an MA in International Development from the University of Denver. And I'll also just introduce Ben Heeley. Ben is the Director of Clean Energy Finance at the Connecticut Green Bank. At the Green Bank, Ben helped develop Connecticut's commercial property assessed clean energy program and has helped build clean energy investment partnerships with emerging players such as foundations and crowdsourcing platforms. Earlier in his career, Ben served as the staff director to the Committee on Environment and Natural Resources in the Massachusetts State Legislature. In addition, Ben has experience working on public power deals with Morgan Stanley and in clean tech investing with DBL Investors, a double bottom line venture capital firm. He holds degrees from the Yale School of Management and the Yale School of Forestry and Environmental Studies and Yale College. And he's a former member of the New Haven Board of Aldermen. So with that, I'll turn it over to Travis. Take it away, Travis.
Thanks, Nate, and thanks everyone for joining today, taking time out of your busy day. I'm going to talk probably for about 30 minutes and then pass it over to Ben. He's going to talk about a specific case study from this guide, but I will start off by introducing this particular guide. It is intended as an information resource for state and local officials, and also sort of as a how-to guide to set up publicly supported loan programs. By publicly supported loan programs, we are referring specifically to these support structures that state and local governments can build to spur lending to distributed solar in their particular jurisdictions. The guide defines publicly supported solar loan program as a codified body of rules, platforms, and support mechanisms that facilitate private lending for rooftop solar installations. And when I say support mechanisms, I'm referring specifically to credit enhancements, which are financial mechanisms used to leverage private lending and build marketplaces within certain jurisdictions. So the rationale behind this guide is that the distributed solar sector is growing. We're referring specifically here to residential solar. It's sort of to keep the focus clean, but some of the stuff we talk about here can also apply to commercial. But if you look specifically at residential, we've had year over year for the last 5 or 6 years over 50% annual growth. Employment numbers are very strong. I think some of these numbers will change in the coming year, but this is just as sort of the market settles, and we're witnessing some changes too that could affect things on a nationwide basis. But with such a strong emerging economic sector, it's behooving of states and financial institutions to sort of take notice and get involved. States and local governments have been critical to the support of solar and other renewable energy technologies, and certainly in the past, and I think that's going to be even more so true going forward. But education is a big piece of this, and as Nate mentioned, this project or this guide was produced as part of the solar training and education for professionals, and CESA's specific role in this is to educate state and local officials. So this is just one more sort of resource for them to look into deploying more solar within their particular territories. So I'm going to kind of run through the guide at a good clip here, high level. The guide is available on CESA's website, and I encourage you to take a look and look at some of these things more in depth. But I will start with the first section of the report, which is titled Preliminary Assessment. This is really sort of your market research, your market assessment. What are you kind of working with within your jurisdiction? What are the financing options available? What's the market infrastructure? What's the demand? What kind of policies and incentives are available in your state or local territory? And what kind of funds can you apply towards the development of a program like this? So this chart right here shows you, it's fairly comprehensive, the financing options available for residential solar and some commercial solar as well. Available on a nationwide basis today. You've got your third-party products up top, the lease and the power purchase agreement, and then below you've got various loan products. I should mention, you see there at the very bottom, I mentioned PACE, and there's also on-bill towards the middle of the chart right there. While those both, I think you could consider them generally within the realm of publicly supported loan programs, we won't discuss them here. They're kind of their own animals, and they have their own playbooks, which don't necessarily, a little bit sort of outside the scope of what we're talking about exclusively today. But there's information on both of those types of programs available online. I encourage you to sort of check those out. But your first step here is to kind of assess what is the existing market that we're working with here as a state or local government, to say what are the financing products available, are they competitive, do they offer homeowners a good deal, and do they provide us with local economic development opportunities, right? Are local banks or credit unions or other financial institutions involved? So you want to do a survey of what's available on the market, determine what the gaps are, do a gap analysis, and then take a look at what's driving the economics, what's driving the demand in the marketplace right now. I've got sort of, I apologize for all these arrows and gears here, but what I'm trying to communicate is that this can be a complicated sort of interlocking matrix of various things that you're going to want to consider. For one, is net metering available in your district? What's the solar resource? Is it low? And if it's low, what kind of incentives are available from state and local governments that could drive the economics of solar on people's rooftops? There's the ITC I've got right down there at the bottom. That's the federal tax credit for solar installations. Moving over to the demand gear, you've got your consumer demographics. What are the income levels? What are the home ownership levels? What's the roof space available? Do people want solar? Is this something that people are interested in, or are they not kind of aware of how it works? RPS is Renewable Portfolio Standard. That's a statewide mandate for utilities to procure a certain amount of renewable electricity that they serve in their portfolio. And when one of those is present, there could be, or there usually are, renewable energy certificate schemes, which could boost the economics of solar systems. And then you've got your market activity. What's the supply chain? Who are the installers? What are the install rates? These are all things you want to consider, and again, sort of do a gap analysis for how you as a public entity, as a government, can step in and fulfill a market function, and provide some scale maybe if things aren't quite there, the economics aren't quite there, or whatever. You sort of have to provide a boost to the market. Another question is, how are you going to pay for it? What funds are available to you now? This is sort of a list of funds that we've identified, that programs that are existing today and have existed in the past, solar lending programs run by state and local governments. These are funds they have access to administer their programs, to set them up and to implement them and then to administer them. This is not comprehensive by any means, but you see here that there could be several things. You could get on the utility bill with a mill charge. You could Massachusetts Solar Loan Program set up theirs through an alternative compliance payment fund that they had set up, where the utility was paying in when the utilities were paying in when they weren't meeting their obligations for a certain year. There's state general funds. There's all kinds of special appropriations you could make. One particular loan program, this second to last bullet here, was set up with a lawsuit. The utility had either settled or had not prevailed in a lawsuit, and was obligated under the terms of that case to pay to a fund, and the local government, it was a municipal loan program, they decided to use those funds to set up this solar loan program and get some deployment going within their own territory. And then there's these American Recovery and Reinvestment Act funds mentioned at the bottom here. That's ARA. Those are no longer sort of available, and but there are some that have been sitting on some state and local balance sheets that can be repurposed for things like this. So we've talked with a couple folks about that sort of thing, looking to design a solar load program based on these ARA funds that they've had to sort of redirect. So that's the first section. I'll just say real quick that state and local governments, typically they can be resource constrained, and the decision needs to be made about what kind of capabilities are available to begin a solar loan program, and what the resources are to do so. And if you're running on, if the meat is close to the bone and you're running a lean operation, then that'll sort of affect how you design the program. But it is also important. Oh, excuse me. Sorry, I got a little ahead of myself here. That's the next slide. But I'll jump on to the next section here. We've got program design and implementation is the section after the market assessment. So once you have a good idea of what the pent-up demand is, what the economics would look like, you can hire a third party to do an economic assessment, or you can conduct it in-house if you've got those capabilities. Then you're going to want to actually get to work designing the thing. So choosing the credit enhancement is kind of where the rubber meets the road in this part. This is the mechanism which is going to determine how you support private lending, and what the leverage factor is, and who you bring in, etc. So that's a very important step in this whole process. You're going to want to consider how this thing is going to be administered once it's live, and the agencies that will be responsible for administering it, whether that's an existing agency or a new agency, or if you devolve that to your partner in the program, like a lending institution. Stakeholder engagement is very important. You're going to want to select which financial institutions can participate, set the criteria. You're going to want to meet with them to discuss all this stuff. You're going to also want to do that with your vendors to determine what the needs are, and that's going to ultimately inform what your design is. So you don't want to have this, to build this thing and have nobody take advantage of it, have no partners and have no consumers actually take out loans. The idea is to sort of get a sense of everybody's requirements and to meet those where you can, and to basically launch a successful program. Product specifications and implementation, I have a couple slides at the end, I'll get into those. But launching right into it, I'm going to talk a bit here about the credit enhancements, the specific ones I've discussed in this report. Again, non-comprehensive, but these are the ones that have been used. So we've seen these in use in practice, and I'll discuss each one individually starting now. So that first one, LLR, stands for Loan Loss Reserve. That's essentially a fund that's set aside to provide backstops, or to provide a backstop against a portfolio of loans. So in case there's a default in a loan portfolio, this loan loss reserve can pay out to cover some of the costs that a financial institution would experience in the case of such a default. And it can be used for other things too, meeting delinquent payments, things like that, making the bank whole. So you kind of have to decide what the rules of this particular fund would be. But they can be particularly high leverage mechanisms, which means that they can generate a good sizable amount of private investment for a low public expenditure. And one of the reasons that we've identified it as such is because this is a fund that's set aside, and it is purposed specifically to backstop loan portfolios for a certain amount of time. But if the fund is not drawn down, or to whatever degree it is drawn down, whatever funds are left, you can repurpose. You can pull those out after a certain stipulated period and use them for some other priority at the state or local level. And they are also not terribly difficult mechanisms to set up and to use. Interest rate buy-downs. This is when the public funds are used to essentially, without getting into too many details, the report's got a little more here, but you essentially reduce a borrower's interest rate by paying a lender, and this lowers the cost, obviously, to the borrower, so that their cost of energy, the cost of solar energy they get from their system, which incorporates these financing costs, can be competitive or more competitive with their utility rate. So interest rate buy-down, this was, for example, see this in the Mass Solar Loan product, the Massachusetts Solar Loan Program, And with energy prices where they're at in Massachusetts, and with the SRECs where they're at in terms of price, the value you're getting for those renewable energy credits you're generating from your system, and with these particular credit enhancements, you can get homeowners a very good deal. They can pay off their systems very quickly, and it's helped to drive a lot of deployment in Massachusetts. So, you know, if ramping deployment is a consideration, then certainly you might want to take a look at applying mechanisms that maybe are a little lower leverage but have a little more of an effective impact. Interest rate buy down, it's a direct payment, so that's a that's a debit on your balance sheet. These are not funds generally you can repurpose, so the leverage is a little lower, and the complexity might be a little tougher because you have to determine at kind of what level is optimal. They can be expensive instruments, so you know, while the leverage I've got there is sort of like a you know, mid-grade, you can wind up actually paying a lot, which may be within your capability and may be within your goal as a state or local government. That's something you have to sort of assess and decide. Direct payments, like interest rate buy downs, it's sort of it's like a grant essentially. It's just giving money to either reduce the upfront price of the system or to some other purpose. These are, you know, low leverage instruments, but they can be very effective in getting borrowers a good deal on their system and enhancing payback. I've got here as another example, Mass Solar Loan did this and the interest rate buy down. So while the Mass Solar Loan program may have been a high-cost program, or, you know, relative to some of the other case studies we mentioned in this report, it was also very successful in driving a lot of deployment. So that's a trade-off that, again, it's a consideration. Warehousing. So we've got Ben Healey, who's going to discuss the Connecticut Solar Loan Program, which is no longer active, but was also, while it was active, very successful in driving deployment. And they had this interesting structure that required a bit of financial savvy and some capability. Ben is with a Green Bank, so this is what essentially a Green Bank can do. It's sort of within their wheelhouse to set up complicated financial structures and execute securitizations on a back end that may not be within the bailiwick of a state or a local government that maybe doesn't have this expertise in-house, or maybe not have the fund to set these things up. But warehousing is essentially a way to move assets across balance sheets and to achieve a sort of beneficial cost of capital for the borrowers. Again, it's a little bit more of a complicated mechanism than like a straight interest rate buy down, but in Connecticut's case, it was pretty successful. This chart, or this graphic right here, kind of shows you the basic arrangement. I think Ben's going to go over this a little bit, so I won't spend too much time here. But you see that SunGage here on the far right, in the Connecticut case, was the originator of the loans. They work with the contractors which install the systems. Then you're moving towards the middle of the graphic, and you've got CEFIA, which that's the Clean Energy Finance and Investment Authority. That's the old Connecticut Green Bank name. They set up this warehouse, which was essentially an LLC. And they would hold the loans, and they would sell them as a securitized debt to Mosaic, and they retained some of the asset value which functioned as a form of subordinated debt. And I'll get into that right here with this next credit enhancement mechanism. Subordinated capital is essentially, it was sort of special in the Connecticut Green Bank's case because they were holding on to some of the cost of the loans which they were holding in their warehouse. But in other cases, subordinated debt can just be an investment by a public entity where they're in a first loss position. In other words, they're subordinate to senior investors. So you know, whatever sort of losses come from that investment, defaults, the public entity will bear those first, and they're usually the last to be paid too. So this can reduce the cost of investment for a private investor, which could reduce the overall cost of capital for a project investment. And those get passed on to the borrowers in the form of better solar economics. So I'll just breeze through these last couple slides real quick, and then we'll pass it off to Ben to discuss the solar loan in Connecticut specifically. Administration, you're going to want to consider what agencies you're working with. Are there existing agencies that can take this on? In the Massachusetts example, the Department of Energy Resources spearheaded the development of the loan program, and then Massachusetts Clean Energy Center took on the administration of the program. They sort of now have ownership of it. So there were two sort of public and quasi-public entities that were in line and capable of doing this. Maybe a new agency is required, or maybe you set up a green bank specifically for this purpose, or to take this on as one of its in its portfolio of actions they take to drive clean energy deployment within a particular jurisdiction. Or you can devolve, as I mentioned earlier, the administration to a program partner. We've seen this in municipalities where they may not have the staff, the FTEs, or the funds to sort of continue ongoing administration. So you pass it off to either one or two partners, a bank or a credit union, and you say, you're responsible for developing your own underwriting criteria. You're responsible for taking care of document services, working with the vendors, et cetera. We'll just keep the funds set aside. We've got the credit enhancement in reserve in case you need it. But otherwise, the program's sort of yours. Considering costs and FTE requirements, full-time equivalent requirements, do you have the staff on hand and can you pay them to do this? And then what kind of assets and infrastructure do you need to build to execute this thing? Massachusetts has a web platform. The municipal loan programs usually didn't. They would sort of give that to the banks and credit unions to take care of. And you may need to have a system for vetting vendors and new partners that you're going to onboard, new financial institutions, and then there's the application clearinghouses and document processing and all that stuff, which requires a bit of application. So you're going to need to design systems for these or devolve them to a program partner. Stakeholder engagement. In designing this thing, you want to make sure, again, that you're not just going to build it and nobody comes. You're going to want to engage the lenders in your area and the solar installers and maybe even the homeowners to figure out exactly what everybody's story is and how you can design a program that will meet as many needs as possible while still maintaining the, still staying within the bounds of what your capabilities are. Lastly, I will just say that implementing this, even though this is, I don't want to be disingenuous by suggesting that one slide is all you need to talk about implementation, but in the spirit of moving quickly, you're going to want to consider what the approvals are. Who needs to sign off on this? Does this need to go all the way to the governor, or there are some sub-agencies and offices that can sort of take care of this? That'll sort of facilitate your pathway to getting this done. You're going to want to understand that at the outset so that you don't run into snags later. Accountability and transparency. This is a public program and taxpayer funded. So you're going to want to understand how this thing works in practice, what are the successes. You're going to want to have definite metrics in place, invite public comment. During the stakeholder process, you're going to invite comment as well from your various stakeholders. But while the thing is operational, you want to make sure that you can adapt it as needed. Again, if that's something that, if you're administering the program directly. Duration, these are typically not designed, publicly supported loan programs are typically not designed to be perpetually enduring programs. They have end dates, usually shelf lives. They're meant to sort of spur private lending and get marketplaces going. That's sort of what governments can do best. So the idea here is, how long is this thing going to be in place, and at what point do we wean the marketplace off of this product? Are we going to have a series of stage gates, is a series of metrics, milestones, or is this like we're going to give it 5 years and then cut it off? That's something you're going to want to think about because that's going to influence how the market picks it up in the absence of the public support. And then, of course, there's marketing. How are you notifying the consumers, the people that are going to actually be taking advantage of this program? You can do this several ways. Again, you can devolve it to your partner. Give it to the vendors and let the vendors run with it. You can launch your own campaigns. You can partner, and Ben might mention this. Certainly, Connecticut did it, but also other states and municipalities have done it. If you have a Solarize campaign, which is a bulk purchasing program that you are notifying people about to try and get them to take advantage of lower cost solar systems, discounted equipment, then you can certainly pair it with something like that and sort of double up the marketing so you get an efficient broadcast out to folks. So that, I believe, is everything I had. This is the case studies. This is the third section of the guide. You see here that I looked at, or we examined the Mass Solar Loan product, Connecticut Solar Loan, the UVA Community Power Saver, Community Credit Union Power Saver product, and then there was a City of Milwaukee Solar Loan program. The woman that spearheaded that is actually at Sunrun now, so she did a good job with that, and she's sort of taken her state and local knowledge to to the national scene. But I will turn it over to Ben now to let him speak specifically about the CT Solar Loan Program. If you're interested in the other case studies, please pick up the guide. And if you have any questions, please don't hesitate to contact me or CISA, and we'd be happy to answer them here as well. So thank you for your time, and Ben, take it away.
Great. Thank you, Travis. Nicely done. And while I was hoping that someone was going to let me talk about UVA, I guess I'll stick to my wheelhouse and focus on Connecticut. So by way of quick introduction, glad to be on the call with everyone, and thanks for your interest in the solar loan topic. I know, hard to get more exciting. My name is Ben Heeley. I'm a director on our finance team, and that's sort of code for our investments team at the Connecticut Green Bank. I'll do a quick bit of background on the Green Bank and then dive a little deeper into sort of the specifics of how we set up this program, and then try and keep it short so that folks can ask questions. I speak from a position where certainly knowing that not everyone has the benefit of a green bank within their state or locality, but I think a lot of the lessons of what we did and have done can certainly be translated, and absolutely happy to talk offline with anyone who's really thinking, man, this is what kind of fun I want to have in 2017. So with that, let me dive right in. All right, so a lot of words on this one, can be part of the take-home reading, but the Green Bank in Connecticut, formerly, as Travis said, the Clean Energy Finance and Investment Authority, was set up back in 2011, and really that first bullet point is the key idea. Connecticut saying we're not going to be able to achieve our clean energy goals with a subsidy and grant-based approach. We need to bring in private capital and financing. And that second bullet point, the idea of in all the deals we do, leveraging our limited public funds with private investment, and then actually bringing those investments back into the fold so that we continue to circulate them. The lowering the cost is clearly a big one. That third bullet point in the solar loan is actually an example that we're proud of that manages that. And we've recently added this fourth bullet point, which is really around affordability and equity within the clean energy space, and focusing our work as a capital provider and financier on LMI populations, thinking hard about how we get over some of the credit hurdles and other challenges that have prevented equitable distribution of clean energy when it comes to distributed resources in the industry broadly. So that's the basics on who we are, and to put it into a pretty chart, the idea is as time goes on, we get more capital in, we use less of our dollars, and we accelerate deployment. So the triangle chart, as we call it, nothing more to say there. And just to get a sense, and again, this is where I sort of realized that the privileged position of being in a green bank came in 4 years ago with a significant balance sheet that we've continued to build. That balance sheet came out of the old Clean Energy Fund in Connecticut, which is a system benefit charge fund that is supplemented by a not insignificant regional greenhouse gas initiative allocation every year. So we supplement that with a variety of other sources. but it is important in terms of thinking about how we thought about this product development and would be a challenge for others to start with, which is where does the initial capital source come from, how do you source it, and how do you put this together? And certainly for those who aren't sitting on a balance sheet, I still have plenty of advice to give on that front. So that's who and what we are. All right, now let's get to the meat of it. Now this is the beautiful looking Stout family, and in fact, David there on the right showing the showing the energy production of his system has gone on to join a solar company in Connecticut, so makes us very happy all around. But despite the snow on the ground, that is a system that does very well on their house on the left, and they were one of the original folks that took advantage of the solar loan program. So what was the solar loan? Now this is a complicated chart, so if I had been thoughtful about this, I would have eliminated the left to start with and really just started with the two upper right corner, the Connecticut Green Bank and SunGage. So back in 2012, we were in a position in the market where really solar loans were not a major offering. There were some banks, as folks might know, Admirals and others of that type, that were offering a solar loan product using sort of the federal Power Saver tool. But what we were trying to do was really provide a lower cost, long-term option, meaning 15 years plus, that could be cash flow positive to the customer as soon as possible, allow them to take the investment tax credit themselves, serve as an alternative to the lease and PPA model for those who really wanted to own their solar, and do it in a way that was affordable and, frankly, didn't require, and I think about this coming out of the recession, equity in their homes, which I think is really the predominant way that folks were accessing capital to finance solar at that point in time. Think about a world in which home equity was much more constrained. Not to say that is not still the case. We find it to be so. But that was the idea, and we put out an RFP using a little bit of RSEP money, the federal dollars, as intended as sort of a carrot to come on in. And those RSEP dollars, not as grant funds, but really as credit enhancements to a structure. SunGage, which is now a major player in this world, in the solar loan world, was just getting started, and they came to us with an idea of putting together a fund where SunGage would serve, and this speaks to some of Travis's points at the end, as the originator, as the channel marketing partner, and as the servicer of the Green Bank in terms of building a product, a solar loan product. When you think about building a product, that means everything from setting rates and terms to what are your standard contract documentation to, who's going to collect the funds and what are the processes associated with that, to what's the platform by which this gets marketed, all those things. We worked with SunGage to put that together. And the Green Bank essentially said, we will provide the balance sheet, meaning we will provide the capital that SunGage can use to issue loans on our behalf. So effectively, we set up this CT Solar Loan 1 LLC, which is the special purpose vehicle in the middle of this chart. And we said to SunGage, you go out, you work with contractor, installer, and developer partners who are talking to residential customers. You can use our money every time you get one to say yes. That's the basic idea. So SunGage managed the contractors. The contractors are the ones out there talking to their customers. And a customer at their kitchen table could say, great, I'm excited about going solar. Oh, you have a financing product for me. I'm a person who has some tax liabilities, therefore I want to own this thing. Or we call it, as we do in Connecticut, I'm a prudent Yankee. I want to own it rather than enter into a PPA. And that's really where this all builds from. So starting at the lower right, the customer says, great. The contractor says, here's how you get in touch with SunGage. SunGage has this portable program, on the iPad or what have you. And we close the loan there. The Green Bank funds it. Now, in line with the mission, the idea is the Green Bank recycles capital and leverages private dollars. And so part of the fun of this product was because there was not a big solar loan market, let's call it a secondary market, meaning, okay, you've got a bunch of loans on your books. Do you have to hold them forever, or can you, send them out to another financing party who might be happy to take them? We then spent it took a little while because this was a new product. But found both Mosaic, a California-based, originally a crowdsourcing platform, and now a major solar loan originator in its own right, in fact, competitor with SunGage. So if the SunGage guys are on the phone, well, congrats on building a market that you could compete in, literally. And the Reinvestment Fund, a Philadelphia-based CDFI that was a community development financial institution, that was interested in building a portfolio of clean energy assets. And the Green Bank on the back end basically structured our loans into a pool. For those of you thinking mortgage pools, you're thinking about the same kind of vehicle, but much less dangerous. And we then went back out and recapitalized ourselves with funding from Mosaic and the Reinvestment Fund. So both of those two entities, any given month, get the bulk of the payments coming in from the portfolio, and the Green Bank holds on to a portion of it and basically takes the first loss if there is any. Now, I'm happy to say over the past 4 years or so, we have had no defaults. We've had some delinquencies, but they've all come present, and it's been a very successful program. So let me jump off this complicated slide, but I think this really gives you the heart of what we did and how we thought about it. The approach, this is the dream, right? When we want to do this for all of our products, and I would think this is how I'd encourage any other government entity to think about the world. Not that you want to own it in perpetuity, but build something where you can show a product works, develop it, have some proof of concept, use a limited amount of capital, either your own or somebody else's, and I do think there are ways to use somebody else's. And then, as we call it with SunGage, graduate that product or that partner. And really, the success of the SunGage model, which we've seen now with other partners in the solar loan world, Mosaic, Sunlight Financial, Dividend, others, they went out and partnered with Digital Federal Credit Union, a Massachusetts-based but national credit union, to go from our little $5 million seed fund to a $100 million fully private program. Just so you've got it, and this product has evolved. I don't know that we would offer this exact same product now in terms of all these criteria in 2016 as the market has changed, but in 2012, this is what we went out with. 15-year product, 6.5% interest rate. Originally, there was a down payment involved, but we actually eliminated it for a variety of reasons that happy to discuss online or off. A FICO score at 680 and above, which covers, sort of what you think of as, most prime and maybe a little bit below, depending on how you define that. We're certainly seeing more opportunities to go below that credit criteria, and in fact, based on our incredibly good performance with the product, I would encourage programs to think harder about lowering that credit criteria to expand access. The reamortization provision, for those who aren't knowledgeable about that term, is basically just the idea that you can change your monthly payments if you pay down some of the loan using investment tax credit dollars. And certainly plenty of our borrowers, we found, really love that provision. And then one of the things, whether it's a PPA or a loan, that homeowners always care about is if I'm not in my home for 20 years, what happens? And so the assignability is important. I'm coming to the end here, but I think this last slide I want to show is really how, and this is a case in which there was a down payment required, so this is an early day slide, but just how cash flow positive this can be for a customer over the length of a system lifetime. This is using Connecticut assumptions, of course, so looking at savings based on Connecticut utility rates and all the rest. But this kind of analysis, while maybe not what we would present exactly to a customer, certainly we weren't the marketing pros, the SunGage folks were. We really think hard about how to make this an attractive offer from an economic perspective and truly benefit the customer. So do I have anything else to say? I guess I have to say thank you. And it's 1:44, so let me be quiet, and if there are questions, certainly welcome them. And otherwise, thank you, guys.
Well, thank you, Travis and Ben, for your presentations. Very helpful information there, and we've got a lot of great questions coming in. Before we get to those questions, I just do want to remind folks that this presentation is based on a guide that's authored by Travis, graciously authored by Travis, and it's available on CISA's website. It should be available on CISA's website as a featured resource. You can also access it through our Sustainable Solar Education Power Project page, so you should be able to get at it that way, and you can download it for free. So we do have a bunch of great questions coming in, and we'll just take them one at a time, as many as we can. So one question is really a two-part question. Are there particular, and I think this is probably best geared to Travis, are there particularly ripe state markets for solar loan programs, and are you aware of any states that are actively considering establishing a publicly supported financing program like this?
I'm not currently aware of any that are looking into it at the state level, but I would say that any state that, there are certain fundamentals you need in your marketplace, net metering at the retail rate. If you've got an RPS that the prices can be supportive of solar economics for the RECs. If there are other state and local incentives that are available, certainly those things will determine where the economics make sense. Also the resource to a lesser extent in the residential sector. But those are the places you're going to want to kind of take a look and see. And is there interest at the government level, and is there consumer interest, right? Virginia is one of those places that NREL has talked to a little bit. They have a lot of interest, and in fact, one of the programs that is discussed in the guide is based in Charlottesville, Virginia. They seem like on the cusp of making something happen, and we did talk to them about the possibility of launching one of these loan programs. But I can't really, besides that one, there's none I can really identify right off the bat. It's just kind of a matter of assessing where it makes sense, where governments are supportive of it, where the policy goals are, and then going from there.
Great, thanks. A question for Ben. Can you sort of explain a little bit more about why and when the Connecticut Green Bank chose to phase out or to privatize some of its financing products? Is there a concern that there's too many financing products on the market? Was that part of the calculus there?
Yeah, it's actually less about too many and more about are we needed. So the goal of the Green Bank, while I wouldn't say it's purely additionality, there can be times when we might not be fully additional to the market where we might play. The general goal is if there's a private market capital solution that is both widely available, easy to access, and hit some of our equity goals, we don't need to be in the way of it. So as we were considering upsizing our commitment to the solar loan product, we were also encouraging SunGage and others in the market who were looking at solar loans to see what kind of capital terms they could get without us in the mix. And due credit to SunGage and their team, they did a really great job of basically getting Digital Federal, the credit union, to match the terms that we already had in the market without the need for our credit enhancements, with the same credit score thresholds. And so we said, God bless you. We can put our capital to work in other more challenged markets, lower credit scores, different technology solutions other than solar, et cetera, et cetera. So for us, it's a real success to be able to say this market is working without us. We're out of a job on this one. Let's figure out the next job to take on.
Great, thanks. A question back to Travis. Are there programs that you've observed, solar loan programs, that haven't seen a lot of uptake or that have otherwise failed? What other risks, aside from sort of maybe potentially not leveraging resources well or lack of uptake, are there for establishing a program like this?
So I should begin by saying that there's not a ton of these as living examples. So I don't want to, if I say that I haven't seen any programs, or I've seen some programs that are not successful, I don't want, the line to be drawn easily back to what I'm talking about. But, I think it just depends on the amount of sort of firepower that you can direct to this. If you've got a sizable amount of capital and you've got a machine that can get the word out to homeowners, that can demonstrate the economic case, and you've got program partners that are active, and these things will determine success. But if your resources are a little more constrained, you're working at the municipal level maybe, you might not sort of witness an overwhelming response to the program, which is not to say that the municipal programs that are documented in the report didn't do well. I think that they were able to scale loan originations at an appropriate level within the jurisdiction. And one of them is in Wisconsin, and that's just not a place where people are going solar in droves. So I think they've done very well considering the market they were working in, and the amount of capital they were able to direct towards the credit enhancement. The numbers are in the report. I forget what they are, but it's not a massive amount of loan originations, but it's sizable for what they were working with. So I just think that resources are very important. Execution, obviously, in everything is important. But starting from a solid base of having a market that you can work with, and being able to find the right partners and design a really robust support scheme. Those are very important, and they will determine the success of a program.
Yeah, I would add to that. This is Ben. I think Travis hits on it really well when he uses the word partners. In our experience, and this is true across the programs we run at the Green Bank, the capital availability and structuring of it is critical. It's a necessary piece of the puzzle, but it is a necessary but insufficient piece. And what I mean by that is, with this loan program, as with others, whether it is a master originating partner like SunGage working with contractor channel partners, or whether it would be partnering with a local credit union that has branches, or with a community network, or the ways in which we've run what we call these so-called solarized programs, which are basically nonprofit-driven community buying efforts where discounts occur as you aggregate more customers. Having a strategy on that part and partners who are prepared to execute, because a government entity, and we found this even, we think of ourselves as relatively flexible, simply doesn't have necessarily the resources to drive uptake. Because these are not grants, this is financing, and people don't wake up in the morning and say, hey, I really want to finance something today, well, unless you're a banker. They need to want the product. They need to have a desire for the underlying tech, and then the capital solves a problem. That I think of as equally, if not more important, and putting those pieces together is the recipe for success.
Great, thanks both of you. And next question, actually, maybe both of you want to take a crack at as well. So this guide was produced and this webinar was produced under a project that's aimed at giving access to low and moderate income folks. How can you assure greater low and moderate income participation, and what types of publicly supported loan programs might be easiest to replicate across the country with an eye toward expanding solar access to low income customers?
And I'm going to refer to you, yeah, because you're dealing with that right now.
Yeah, we are. We're in the mix of it, and it's just a tremendous question, and it speaks to the heart of sort of the politics of this for sure, and more broadly, equity and distribution associated with where we want the grid of the future to look. I'd say it this way. So we've some good and some bad here. We have created a set of solar incentives, in fact, that are higher in Connecticut for low and moderate income folks, about double the value on a per watt or per kilowatt basis of what we call the market rate of Green Bank support, and this is a pure subsidy type approach. And we have two ways of supporting the market. We do it, one we call a performance-based incentive and one upfront buy-down. The PBI, performance-based, gets paid out over time, and we use it with third-party, either lease or PPA providers, to sort of keep them honest that they're maintaining their systems and doing what they're supposed to do, versus homeowners get their upfront rebates. What we have found, and there's some more complexity there, but that's the high level, what we have found is within the LMI population, and this is a general rule which is therefore wrong in many ways, but nonetheless useful, because so much of solar value is driven by tax credits, it's really not as advantageous. You know, depending on, obviously everyone's tax liability situation is different, it's generally not as advantageous to structure a loan program because the tax benefit of the solar doesn't work as well. There's not the same value to be taken there. And, you know, plenty of cases, again, where you could caveat this. But we've therefore focused from a programmatic angle on supporting attractive lease and PPA options aimed at the LMI community, where rather than a loan structure, we've encouraged companies with natural ability to market and deliver the economics that really will be energy saving to still homeowners, but LMI homeowners for whom the tax benefits of solar are not as apparent, and therefore the loan structure and ownership doesn't bring the same bang for the buck. And the last thing I'd say on this, and obviously there's plenty more that could be said, is that especially in LMI communities, the ability to have channel marketing partners, whoever they are, who are local, who are trusted, who are really based in the community, is critical to getting uptake. And this sort of solarized model of trusted local ambassadors helping tell the story and encouraging folks to come along has been really incredible, whether it's in Bridgeport, New Haven, New London, Hartford, other parts of Connecticut. We're still only you know, sort of breaking through. But we've got about 1,000 systems that just in the last year have come online or in the development for LMI communities, and we're proud of that. It's early days, and it still trails well behind the non-LMI, but this is a real focus for us, and it has to do as much as anything with a PPA or lease model that is geared towards this community in particular, and really brought to the community by folks that can say something and understand, you know, make a case.
Great, thanks. Well, we're getting close to the top of the hour here, and I do want to be respectful of everyone's time. So maybe we'll shoot for one more, and I apologize we couldn't get to everyone's questions, but perhaps offline we can take some of these questions as well. So this last question has to do with, it's really more of a comment on some level, but has to do with loan loss reserves. Solar loans will have a long tenure. Will administrators be able to run the course will be able to run the course of those tenors, you know, and this person notes that this isn't really that simple. Interest rate buy-downs in some ways are actually less complex, and it does reduce payment because a customer does not accrue as much interest over time, and also a question on whether there's data on loan loss reserve experience for programs using them.
So I'll take a first crack at that. I'm not aware of any data. I certainly have not collected it, and I don't believe anyone at NREL has either on you know, the effectiveness of you know, how well they can support solar deployment, or you know, drive success in a particular program. I think that in this case you might find a useful proxy in some of the credit performance data that might be available, say like in you know, there have been some securitizations of solar assets over the last couple of years, Solar City Sunrun and AES, I believe, and they generally, the pre-sale reports that are available, and I believe they're publicly available from the rating agencies, will generally talk about some of the credit data, and you'll see sort of an emerging narrative over the years, right, from 2014 to 2016, when the last one was, I think. You see that the credit rating agencies have gotten more and more comfortable with the performance of these assets from a credit perspective. People are generally paying their bills, and the ratings agencies will assign an appropriate credit rating to that investors feel comfortable with. So the credit data on these solar contracts, whether they be loans or third-party contracts, at this stage of the game is pretty good. As this person mentioned, the tenors are long on these contracts, so I think we still have some experiential learning to do, but in the absence of having sort of specific data on loan loss reserves, I think you can look to that data if this is something of interest to you.
Great. Well, unfortunately, I think we're going to have to leave it there. I want to thank you both again, Ben and Travis, for your presentations and your Q&As. Really, really juicy stuff, and we've got a bunch more juicy questions that I wish we could get to. But before we conclude, do either or both of you have any sort of last parting remarks?
Nothing particular for me. I'd just like to thank everybody again for their time, and I hope they find the guide useful, and always open to comments if folks would like to reach out.
And for my part, simply to say, Green Bank team is happy to be a resource as others think through these questions. Capital efficiency, structuring, marketing and partnerships, whatever might be useful, please don't hesitate. We care about expanding the model, and I guess within the realm of my own excitement and energy these days, I'd say the questions and the thinking about focus on LMI, given market penetration for prime customers in localities where the market is otherwise strong, suggests that the need for additionality for Green Bank-like or public program resources could be directed toward credit challenge or otherwise underserved communities, and you can still do that with private capital in a scalable way. That's where I see a lot of opportunity for public sector folks to keep making a difference and changing the game. So thanks to everyone for listening in today and lending your energy to this important stuff. And thank you, Nate and Travis and Sam and the whole CISA team for continuing to highlight this.
Great. Well, thank you. We hope you'll join us for future CISA webinars. We'll be conducting another Sustainable Solar Education Project webinar, one on solar equipment installation and licensing and certification, based on a guide that'll be coming out soon on that topic. That webinar will be on Thursday, February 9th. We hope you'll join us for that, and I'll just pass it back to Sam for a closeout.
Thanks, Nate, and thanks everybody for joining us for this webinar. As Nate said, we hope you can join us for our upcoming webinar on February 9th. You can check out more resources on our website on the links you see on your screen, and there's also some contact info there. Thanks again, everybody, and we will see you